If you have W-2 income and a side hustle, be careful because you might be in the danger zone. And this is exactly why, quote unquote, hybrid earners owe thousands when it comes down to filing your taxes in April. This is what we're going to be covering today. What's up, guys? Mike back at it at Ledgerly, co-founder, CPA partner alongside my good friend, Andrew D'Amico. We are in compliance season. It's quarter one of the year, and that's exactly what we're going to be rolling out over the next few weeks during quarter one to make sure that you're setting yourself up the right way for the rest of the year. So make sure you hit that subscribe button and stay tuned weekly for videos just like this one. So here's the truth. Hybrid earners, what are you? You're a W-2 employee, but you also have a side hustle, and you might be getting hit harder by the tax tail wagging the dog than anyone else filing this year. So if you're a hybrid earner, this video is for you. Okay, let's break it down. You're a W-2 earner, but you also have side income, maybe freelancing, maybe some consulting, maybe an Etsy business, maybe real estate, maybe some other business income on the side, whatever it is, but you're getting a 1099. We're covering this now because it's quarter one, compliance season, and want to make sure that we are not losing out on tax strategies for the year, missing deadlines, losing deductions, or worse, even getting caught in an IRS or state mismatch and potentially an audit. So today we're going to be showing and breaking down exactly what you need to keep in mind for the year 2026 and going forward. So here's the problem. This is why hybrid earners get crushed. The first problem is your W-2 is not withholding against that 1099 income. Your employer only withholds for your employer's job. Your side income, zero withholding. So that can create a massive tax gap and make you owe more federal, more state, and worse, 15% self-employment tax. And speaking of that pesky self-employment tax, your W-2 job, your employer pays half of that. So what is self-employment tax? Self-employment tax is basically FICA, but what's FICA? That's Social Security and Medicare tax. So when you work a W-2 job, your employer covers half, 7.65%, and you cover the other half, 7.65%. However, when you're self-employed, you have to pay the entire 15.3, double FICA. So this is exactly why self-employment earners are getting double taxed. Now, here's the other misconception. When you're a hybrid earner, a 1099 earner, you can take advantage of deductions that you might not even know you can take advantage of. So check it out. Let's break it down on the whiteboard. Look, you're a W-2 employee. You get your income. Then you pay your taxes like we just talked about above. You pay your federal withholding, your state withholding, might get a refund, you might owe, who knows? But then you're paying that 7.5% FICA tax, that Social Security Medicare. Income, less taxes. The rest that you have is what you have to live on. Now, on the 1099 side of the equation, you get your income, and before you pay those taxes, you can take advantage of all these expenses. So the goal here is to shift these personal expenses over to business, and let's decrease that taxable income. What are these expenses, you may ask? Well, you came to the right place. Some of these expenses include your home office, your auto mileage, cell phone, internet, other equipment, subscriptions, education, software. The list goes on, and it depends on your industry. Let's say you're doing an Etsy business at home. Okay, well, you might buy a Cricut, you might buy paint and different materials. Those are all now business expenses because it is ordinary and necessary for you to produce your income for your Etsy business. What if you're a sales consultant? What if you have to download a big software that's going to help you metric and KPIs for other businesses? Well, that software is now a deduction for you. Your home office, I'm in my home office. You bet your top bottom dollar I am writing this stuff off in my business. The list goes on. Do not leave these expenses on the table. Let's shift those personal expenses over to business expenses. And another problem that people are facing is that up here, how we talked about that your W-2 doesn't cover. Well, there's two fixes here that we can take advantage of because the IRS is expecting money for that self-employment income. So there's two strategies that we can do. Well, we can do number one, we can do quarterly estimates. Or number two, we can increase our W-2 withholdings. And what we mean by increasing the W-2 withholdings is that we are actually increasing our day job withholdings. Now, there's pros and cons to both. Increasing the W-2 withholdings can be variable because you don't know how much you're going to be earning in your business. But paying quarterly, we can actually dial in how much you're actually earning in your side hustle. But the con with that is if we underpay, then we might be paying penalties and interest on top of that. However, the most important thing that we need to keep in mind is before we're throwing money over the wall to the freaking IRS, to the freaking state governments, let's take advantage of these other strategies, like taking advantage of expenses that you can get for your business. So let's break it down even further. Let me give you the framework. Let me give you the strategy on how to approach this. So number one, let's separate your W-2 income and your 1099 income, meaning your W-2 is personal, basically. Your 1099 is business. Separate it. Hey, people, guess what? We don't crack where we eat. Vice versa. We don't want to commingle those monies because then it's going to get harder to track, like we just talked about with expenses. Number two is on that 1099 income, let's set aside a certain percentage for taxes. Okay. Our general rule of thumb, depending on what bracket you're in, what state you live in, but let's put 10 to 15% of this to the side. Potentially 20. It kind of depends. Again, this is where you would get your CPA, your tax strategist in the loop to actually plan accordingly to set monies aside before we're paying it to the government. Because again, on that 1099 income, that taxable income, you're paying federal, state, and self-employment tax. We want to minimize those. Number three, based on that, when we have to make those estimated payments, like we said above, we'll either do that through our W-2 withholding or quarterly estimates, one of those two. Number four, probably the most important, and it kind of is commingled with number one. Once you get this 1099, I don't care what people say, whether it's a side hustle, an LLC, you're a corporation, it does not matter. You are now a business owner. You are operating a business. Treat it like a business. So what does that mean? Now we're going to be separating our bank accounts. You're going to be opening up your own checking account, savings account, credit card for the business. Now you're going to have to do bookkeeping. You're going to have to keep track of your expenses. You're going to save receipts. You're going to track mileage, document your home office. Documentation is key, people. So we don't want to lose out on these strategies that we can implement for you. And then number five, this is where we want to look at different entity structures. So you're a sole proprietorship, you're a side hustle. You don't have an LLC. Well, then we might want to be looking at, hey, should we do an LLC? Hey, should we convert you to an S-Corp? Hey, do you have a partner in the equation? Do we need to do a partnership? So as your income reaches certain thresholds, $40,000, $50,000, $60,000, that's where we're going to be looking at different entity structures for asset protection purposes and also tax savings purposes as well. Because when you do the LLC, you upgrade to an S corporation, have a partnership, maybe a C corp for certain different strategies. However, we're talking about compliance. It will open the door for more areas for tax saving and generational wealth. So let's look at a real life case study, a real life example. So let's say you're earning a W-2 of $95,000 and you have side business income of $18,000. So your W-2, for simplicity, W-2 is $95K and your 1099 is $18K. So let's say we're looking at scenario one here. There's no planning. There's $2,750 of self-employment tax. What does that actually come up to? So that math, if we look at this times 15.3%, $18,000 times 15.3% is $2,754. This person is paying the entire amount. They didn't take advantage of any expenses that they could have. There was no planning. And on top of that, they're paying an additional $4,000 in federal and state taxes. So a total of freaking $6,700, $6,800. No estimated payments, no withholdings to government, owing thousands, potential penalties, and no expenses that they could have taken advantage of. For all you Highlight magazine readers when you were a kid, it's like Goofus and Gallon. You guys remember that? This is freaking Goofus. This is scenario A. Do not be a Goofus. Goofus, however you spell it. Don't be a freaking Goofus. Now, scenario B. This is Gallon. This is the good guy. He's working hard. He's taking that side income of $18,000 and he is throwing every expense that he can under the sun. You know, maybe the one thing I don't agree with Gallon is that he made estimated payments of $3,000. We don't want to make estimated payments if we don't need to, if we can take advantage.